Elon Musk is preparing a $1.75 trillion target valuation for SpaceX. It is the largest initial public offering target in human history. To grasp that number, you have to add up the value of every American defense contractor combined, then keep going. At nearly $2 trillion, it outweighs legacy megacorporations like McDonald's. Add in Disney, Nike, Starbucks, and Coca-Cola, and SpaceX is still worth more. This bar chart contrasts the target valuation against reality. Despite the massive price tag, SpaceX operates at a $5 billion annual deficit. A free market would typically reject a cash-bleeding asset at that price, but your retirement account is going to buy it anyway, without asking for your permission. This diagram breaks down SpaceX's internal corporate structure. It actually operates as three distinct businesses stacked on top of one another. The first is the traditional rocket division. It launches government satellites and runs cargo missions to the International Space Station. Rockets get the media attention, but they only brought in about $4 billion last year, roughly a quarter of the company's total revenue. That alone cannot support a $1 trillion valuation. The actual financial engine is Starlink. With over 10,000 satellites in orbit and 10 million active subscribers, this internet provider generates 61. By March, all 11 of the original co-founders had walked out, leaving the platform to be completely rebuilt from scratch. To see how inflated that price is, look at the competition. OpenAI brings in $24 billion annually and is valued around $850 billion. xAI estimates only $1 billion in revenue, but was purchased for $250 billion. This waterfall chart tracks the total corporate cash flow. Starlink and the rocket business generated an impressive $8 billion in profit, but xAI's enormous operating costs wiped all of that out, driving the consolidated company down to a $5 billion net loss. The real SpaceX is actually a distressed asset, bleeding cash. It cannot survive a standard, unmanipulated public offering. To guarantee the IPO succeeds, the financial system intervened. On May 1st, NASDAQ quietly rewrote its listing rules. This timeline illustrates the new fast entry rule. Previously, newly listed companies waited 3 months to establish a fair market price before index funds bought in. Now, that price discovery window is compressed to just 15 trading days. Looking at this pie chart of available shares, we see the elimination of the free float requirement. Historically, companies needed to offer at least 10% of their equity to the public. SpaceX will list a tiny fraction, between 4 and 5%. This equation introduces the hidden multiplier. Buried in the technical language is a mandate requiring ETFs to treat SpaceX's 4% float as if it were 3 times larger. By dropping the minimum float and multiplying its artificial weight, regulators have manufactured unavoidable demand for a stock the market would otherwise penalize. SpaceX executives have openly stated they plan to allocate 30% of this offering directly to retail buyers. Once fast-tracked into the index, the mechanics of passive funds take over. Over $600 billion in automated investment capital is legally forced to buy in. Corporate insiders establish their wealth early based on inflated valuations. 3 weeks later, everyday workers absorb those inflated shares automatically. Passive investing was pitched as the ultimate tool for everyday wealth building: low fees, high diversification, and total convenience. But the exact mechanism that makes it effortless also strips you of your ability to say no. The financial infrastructure originally built to safely grow retirement savings is now operating as guaranteed exit liquidity for the world's richest individuals.